Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. If you're loving what you're hearing on the Real Estate Espresso Podcast, go out and tell 2 friends today. Show them how easy it is to subscribe to the show. The Real Estate Espresso Podcast can be heard on over 20 different platforms, and wherever you listen to podcasts, you're sure to find the show. Go spread the love around. Why keep all this goodness to yourself? On today's show, we're examining why the stock market has fallen so quickly since the beginning of the year. Turns out the same thing happened in real estate. If you go back to 2008 and 2009, when market conditions changed in real estate, why did prices seem to drop so quickly? Well, it turns out that when you make a decision to purchase any investment, most investors have a due diligence process they follow. In our case, our due diligence checklist consists of 2 separate checklists. The first checklist is designed to kill a deal quickly, and if the deal isn't dead after that first checklist, then the second checklist kicks in. There's more than a total of 50 items on the 2 checklists. For complex deals, there are even additional checklists that need to be adhered to. Making a buying decision requires a lot of work. It's a slow process. It can take weeks and sometimes even months in order to get to the point where all of the criteria are met. By contrast, when we make a decision to sell, it's really only a couple of questions to be answered. How much are we going to get for the sale? When will we get our money? And will we get our money? These questions are relatively easy to answer compared with all the effort associated with the purchase. The net result is that a purchase happens very slowly, but a sale can happen very quickly by comparison. Are we unique as investors? I don't think so. Virtually all investors take more time to buy than they take to sell. Even a decision to make a distress sale at a loss can happen very quickly. You either decide to sell or you don't. When you decide to sell, you're making a decision to take your investment to cash. It might be a decision to transition to cash before buying another asset, or it might be a decision to stay in cash for the foreseeable future. It turns out that the market liquidity doesn't really affect the difference between the buy and the sell decision. A sale decision is always going to be faster than a purchase decision on average. For example, when we decided to get into the short-term rental business, we took several months researching which market we wanted to invest in. That involved market studies, site visits, setting up a fund structure, raising the capital, organizing the lending. It took a long time. From start to finish, it took more than 6 months. When it came time to make a decision to sell that portfolio, after 3.5 years of operation, the entire decision-making process took a total of about 15 minutes. It took another week to have the signed sale agreements, and then a few weeks longer before the cash was in our account. It was not a desperate decision. It was not a distressed sale. It was just a very clear risk decision. We felt, in our hearts, there was limited short-term upside to holding the property much longer, and possibly a downside risk. Conversely, there was no downside risk to selling, and that's why the decision was so easy to make. A sale decision is always going to be faster than a purchase decision. Even in a liquid market like the stock market, you're going to spend a lot more time researching a company before making a purchase decision. You're going to look over the company financials, read through their latest news releases. You might review all of their EDGAR filings with the SEC. It takes a lot of time. Now, I'm not talking about the day trader who simply exploits seemingly small random fluctuations in the stock price from one minute to the next. That does not require a lot of research. That trader is simply looking for a stock that shows a history of up and down vibration around a relatively static price with very little upward or downward momentum. Even that doesn't require a ton of research. But that's not investing, that's just day trading, and it follows a completely different set of criteria. See, when you buy an asset that you expect to hold for a period of time, you're going to be doing more due diligence for a purchase than you will for a sale. And that explains why on down days the stock market are much steeper than up days. It's because every investor is quicker to sell than they are to buy. Now, we're seeing market conditions changing in real estate as well. Over the past couple of years, we've seen prices rise very quickly. Some prices in some of the hottest markets have risen 15 to 20% in a single year. That's between 1% and 2% a month. That's a very fast increase. But let's look at how fast prices can fall. We've seen prices in some markets this past month fall as much as 5%. That's a much steeper decline than we've seen prices rise in the last couple of years. And what's the reason? What's the same? A sale decision is always easier and faster to make than a purchase decision. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.